Here's the first summary slide. What it's doing is showing that inventory has been fairly normal for about the last 8-9 weeks. You can see the normal line is defined by the gray line. That's the typical median for the past 10 years, 2015 through 2024 for the same week. And the blue is the most inventory you'd expect. The red is the least inventory you'd expect. The numbers for the current week, which is in the middle of the graph, is over here on the right-hand side. A quarter ago, the numbers are over on the left-hand side. And you only have the trend lines, the red, the gray, and the blue going into the future because that's the trend. You can see that inventory typically goes up just a little bit more in the coming weeks, and then it drops off fairly significantly as we get into the end of the year. Offers accepted, been basically tracing the least the number of offers you'd expect. We're missing about 25% of the market, maybe 20% of the marketplace. It could be as simple as the high interest rates have the trade-up buyers sitting on the sidelines having fewer transactions. Those that have to sell are still selling, and they're still selling in a reasonable amount of time because the sellers that have to sell and the buyers that have to buy are roughly equal, and that gives you the balanced marketplace, even though we are missing those optional buyers. We're missing 20%, 25% of the market for whatever reason. Transactions are just simply the number of closings. You can see that on a percentage basis, they don't line up, and that's in large part because the closings take 4 to 6 weeks, typically 3 to 7 weeks to close, somewhere in that range. There's obviously right around 4 or 5 weeks is when most of the escrows tend to close. 3 weeks has quite a bit of cash transactions closing. Some close as quick as a week. So there's quite a bit of distribution on that. That is actually one of the reasons I look at offers accepted. A lot of people report pending transactions, pending data. To me, that's a garbage number. If you have a cash transaction that closes in a week, it's only pending for 1 week. It only impacts your data for that 1 week. Whereas if you look at offers are all accepted once. That's why I've gone to offers accepted versus those that are currently pending. Days on sold inventory is a seller buyer demand balance, supply demand balance. You can see you're a little bit above normal. You're a little bit on the cool side. The market's a little slower than where Silicon Valley typically is. But keep in mind, to sell out your entire inventory in 46 days, that's less than 7 weeks, when it's normally just short of 6 weeks. That really isn't a significant difference. Yes, your turnover rate is slower, but it's not dramatically slower. Moving on to a very similar but easier to understand thing, how long does it take 3 out of 4 sellers to sell? Typically, it only takes 24 days right here, the gray number, and we're now taking 34 days. So that starts becoming somewhat significant. You're normally selling out everything in 3.5 weeks, 24 days. Now you're taking almost a full 5 weeks to sell everything out. And not everything, but 3 out of 4 sellers. Is it unreasonable to expect to take just over a month, 5 weeks to sell a property? That is not unreasonable. Now, granted, the numbers are a little bit different. Almost half those sellers are coming on the market, pricing their property correctly and selling after the first weekend. So they're selling in 7 days, but 3/4 or 75% of the sellers are successful in selling in that 5-week period of time. Price reductions, very small number. The average price reduction is only 1.6%, but you can see typically it's only 0.9%. So right now you're 75% more price reductions than normal, but you're still taking fairly reasonable number of price reductions, not number, but magnitude. And the reason that number is so small is because the frequency of sellers taking price reductions is fairly small. Basically, something like 80% of the sellers do no price reductions while they're on the marketplace, 75, 80%, somewhere in that range. Overbidding. This is just in raw count. So right now, your typical overbidding is 5.8%. That's why the 5.8 here. You're at 3.3%. So you're missing 2.5%. So the overbidding is almost half of what it typically is, where you're missing 2.5 out of 5.8%. And that's why you're right down here on the blue line. So that's a quick overview. Now we'll look at another summary slide showing the 3 key indicators. Inventory. You can see the holiday impact here for Labor Day that we just went through. When we dip down, sellers don't go on holiday weekends. A little bit more sellers come on after the holiday weekend or before, which is why you have a bubble before and after. They avoid the holiday weekend. And by next weekend, we'll have a return to a little bit more normal pattern. Moving on to offers accepted. Offers accepted don't get impacted a little bit as much in a week later because sellers don't put their house on the market going into the holiday. That means buyers don't have as much new inventory to purchase coming out of the holiday, and therefore you have this little bit of dip. So I'd expect this to go back up next week. And one of the reasons holidays do impact is like Labor Day was a Monday holiday. It varies from September the 1st, which is what it was this year, all the way to September 7th. So you basically have a week range, and that's why it impacts the data to some degree. If the impact was the same every single year and the holiday was on the same date, like July the 4th and Christmas and New Year's, then the impact is more focused. It's the same week all the time. But even those impact the data because on those holidays, it matters whether those holidays are happening on a Monday or a Friday, on which week it tends to impact. And that happens just because of the calendar. If we don't have an even number of weeks that, in a year, you have 52 weeks plus 1 day or 52 weeks plus 2 days, depending on whether it's a standard year or a leap year. And then the most important things, days on unsold inventory, the supply demand balance, you can see that we've been improving. Now that you have a surplus number of listings coming in after the weekend and the buyers haven't had an opportunity to purchase it yet, it is normal for the days on unsold inventory to increase like this. So I would expect it again for next week to go back down. Now we're looking at individual components. This is the level of inventory. You can see you're basically right at the normal level of inventory. We did have a shortage of inventory at the beginning of the year. You rapidly came up and you had a surplus of inventory right here all through second quarter. And then when we hit third quarter, we rapidly fell back down to the normal line. So most of third quarter, we've had normal level of inventory. Here is a comparative normal. So you can see here's your second quarter. Here's the beginning of second quarter right here. Here's the end of second quarter. So basically most of second quarter, you have this surplus of inventory. Went into third quarter, we lost all the inventory. And basically third quarter, we were down here at very close to normal levels of inventory. Doing the same thing with offers accepted, you can see that we've been tracing the blue line starting back here in 2022. You had the run up and the peak of the marketplace in 2022, disagree with me if you want, was right about Valentine's Day of 2022. Now, when I say the peak of the marketplace, that's when the market started to slow, but the market was so superheated that a lot of people didn't see this slowdown until sometime in May type time frame. And that's why a lot of people think the slowdown started in May. It also depends on what benchmark you use. If you're looking at sold prices, there's a 3 to 6 to 7 week delay to get that information. But anyway, the actual market conditions, the supply demand data basically peaked right around Valentine's Day and then came down ever since. And you can see the offers started dropping down, and this was April 1st. And here you can, offers is clearly a significant impact, and you can see how abruptly it came down. And by July the 1st, you were right on top of the blue line. So basically from July 1st of 2022 all the way through present day, for the most part, the volume of transactions has been right on the blue line. Yeah, you're a little bit above, you're a little bit below, you're a little bit above, but compared to where the gray line is, you're right on top of the blue line. So we're missing that standard chunk, whether you want to call it 25% or whether you want to call it 20% of the marketplace. And yes, it was a little bit more severe in 2023. It might have been 25% then. And now in 2024 and 2025, it's only 20%. And that's probably a fairly realistic modeling of what the data is actually doing. Here's the offers. You can see right now we're at 82% of where you'd expect to be. Here's your 80% line. So you can say that basically 2024 and 2025, it's been right around 80%. And that's a little optimistic. And then you can see that actually in 2023, instead of it being 25%, it's actually closer to 30% of the market was missing. And then in 2022, you can see we actually had a surplus at the beginning of the year, and then we rapidly lost it. And here is also the surplus we had go after the pandemic in the latter half of 2020 and 2021. And that was the surplus of transactions. We've more than lost that based on the missing segment of the marketplace in the last 3.25 years, I guess, if you start July to September to October. So 3 full years, not 3 full calendar years, 3 full 365 days. It started July 1st of 2022. We're now almost into October 1st of 2025. Here's days on unsold inventory on a percentage basis. You can see that you were much slower here in 2025. And that's the first time we've been above. Because even in 2024 and 2023, when we were having the lack of transactions, the turnover rate, the supply demand balance was normal. Now you're actually having longer turnover times. And that's why you're above the blue line. The blue line is the slowest marketplace you'd expect. And the purple line is the actual data. Now we had this huge impact here from the holiday, a little more severe than I would have expected, but I would also expect that next week we'll see data coming back up closer to the blue line. Now it could come in closer to the gray line. You have to wait and see how many sales happen this coming week and what happens to inventory, but I would expect it to go back up closer to the blue line. Here's on a percentage basis, so you can see the market was slower, quite a bit slower, and at record low levels. The only time that you were slower than this, in fact, remember I had to expand my graph because I used to cut off at 170, was back here at the pandemic when you couldn't even show property. yes, it was slow earlier this year, but the market's really improved. And you come down here and it's really basically a normal marketplace. It's right there on sort of the cusp of the blue, I would call sort of favoring the buyer a little bit for Silicon Valley. And then everything in the white would be what I call my balanced marketplace. So you're sort of right on that fringe. But keep in mind, what's balanced for Silicon Valley is still very aggressive for the rest of the country. So here's marketing time. What's it take to marketing? Right now, it looks like it's 34 days. So this is for Silicon Valley. That's Alameda County, San Mateo, and Santa Clara counties, all in a blender. Yes, it was taking quite a bit longer just a few weeks ago, but look at this. The blue line, the purple line's really not going up, and the blue line's catching up to it. So your seasonal adjustments. Now, typically, you're way down here at the gray line. So like I think the number was 21 days. If I was to pick it, I would pick closer to 24 days. But whatever number you're going to use, you're 24 days versus 34 days. You're taking 50% longer to sell. That's significant. So even though it's a reasonable pace marketplace where 3 out of 4 sellers are selling in 5 weeks, that's much longer than it typically is for Silicon Valley. Here's on a percentage basis, and here it really stands out. You're up here, you're something like 42% longer than it normally is. But also notice how few time frames are higher than this. And nobody was higher than we were just at the beginning of the third quarter. So just what would that be? July 1st, you were higher, you were slower turnover rate than you were back in the pandemic, or at least equal to back in the pandemic when you couldn't even show property. That's how slow we were. But yet the market felt normal and people were still up. 50% of the buyers are still overbidding right now because they feel they need to in order to get that property. A buyer's not going to overbid if there isn't a sense of needing to do it to secure the property. Here's the largest price reduction. So these are the sellers. Remember I said something like 80% of the sellers aren't doing any price reduction at all. So these are the sellers that are taking the largest price reductions. The 90th percentile seller, he or she is taking a 16% price reduction. So that 1.6% really gets expanded for those that are taking price reductions. It's not that 100% of the market is taking 1.6% of a price reductions. It's 10% of the marketplace is taking 16% of the marketplace. Here's on a percentage basis. You can see that we're taking greater price reductions than we normally do. And this is a good indication that the market is continuing to slow. Sellers are looking at the market in the rearview mirror, and then they're putting it on the marketplace with that research, and they're still misjudging the market on the high side, and the property isn't selling, so they have to do a price reduction. And we'll see later in the presentation in Alameda County that has probably this week, I haven't seen the data yet, the most price reductions, but it's got the most overbidding. So you wouldn't expect that, but what happens is the sellers overshoot their price reductions, and then the buyers are willing to still overbid, even though the property's been on the market because they acknowledge the price reduction the seller made. Here now is the average. So I'm doing this more. I prefer the 90 percentile, but this is on there just to show you that I'm not playing games. Here's your 1.6%. That's actually a little bit less than the most price reductions you'd expect, but it's quite a bit greater than the typical price reductions. The typical was that 0.9% that we saw earlier. Here's the on a percentage basis. So we're taking larger price reductions than we typically do based on the average. Yes, you were down more earlier this year. You were also more down in 2023 as well as in 2019, which was before the pandemic. The frequency of price reductions, here you can see that only 23% of the sellers are doing price reductions. That means 77% of the sellers are doing no price reductions at all, but that's still significantly more than the typical 16, 17% that you have down here on the gray line. Now, in a hot marketplace, you're only having 12% of the sellers reduce their price. So even in a hot marketplace, you have sellers reduce their price. Even back here in 2022, you were having something like 2.5% of the sellers reduce their price. That could be a seller trying to test the marketplace and just overshooting it so much that people were bypassing them. It's also right here at about the Valentine's Day timeframe when I believe the market actually started to change. And this might actually be an early indicator of that the sellers were starting to increase the frequency of their price reductions midway through first quarter. Midway through first quarter is Valentine's Day of 2022. Here's the frequency of price reductions. So you can see that we're about 30% more frequent price reductions than normal. That's somewhat significant, which is why you're up in the shaded blue area. Now here's overbidding, and we're very close to the least amount of overbidding you'd expect, and it's just a hair above 100%. So there's a little bit of overbidding going on, and this is the median. So half the buyers are overbidding the ask price, and half the buyers are coming in under the ask price. Typically, you're up here somewhere around 3.5% of the buyers are overbidding. And that would be the median point, half above and half above 3.5%. Right now, it's basically half above and half below 100% to exactly equal the selling price. And I think it's something like 52% of the sellers are getting more than their asking price. So here's the overbidding amount, and this is based on the magnitude of overbidding. This would be the typical overbidding, which I believe was 5.8%, and the actual overbidding was something like 3.3%. So you're 2.5% below the typical overbidding. Measuring the amount of the market heat hotness based on buyer overbidding. So right now, the amount of buyer overbidding is significantly lower, and at some of the least amount of overbidding. The seller's still getting that 2% overbid, but that's less overbid than they're typically getting. And it depends on whether you're talking about the average or the median. Here's the frequency of overbidding, and you can see you're right at 52% of the sellers are getting more than their asking price, and that's the least that you'd expect. Look at this. Silicon Valley, at least on your expectations, has never been below 38%, even in a cool marketplace. And that doesn't mean you don't get below. You actually did get below. You got down to 32% right here at the beginning of 2023, right after the 2022 price correction. Some sellers are pricing their house automatically low to get that overbidding frenzy going, which may not be a bad pricing model. In fact, right now with a lot of buyers on the fence, that's actually a very good pricing model. If you're able to determine what market value is, and you're able to go out at 98% of market value, that floods the buyers that are on the fence to come in, and now they know where the market is, so they typically will bid the fence, but there's also a fear of missing out, and so there's a huge tendency in a bidding auction type process to stretch just a little bit and pay a little bit more than you would if the house was just on the marketplace. And that's why their overbidding never goes down to zero. Here, the least number, and this is now over almost 11 years, it's 10 years plus the year to date, you never got below 32%. So that's almost a third of the sellers getting more than their asking price. So overbidding is alive and aggressive in Silicon Valley. Now, this may not be reflective of other marketplaces, but it's reflective of what's happening here in Silicon Valley. Here's on a percentage basis. So you can see you came up just a little bit. You were down for the holiday impact, but this isn't the holiday impact of Labor Day because you don't have the closings for another 4 weeks. If you look back 4 weeks in the rearview mirror, you're basically August 1st. So this is just weekly fluctuations. Here's now a pricing model. One pricing model would say we had about 11.4% price increase overall, and that we're just a little bit low. I think a more accurate price model is we had this 12.1% increase for 7.5 years, and the last 3.5 years have been basically flat. Yes, you probably got a little bit better value right here in January 1st of 2023, but you have some ebbs and flows, and you're above and you're below the line. And that isn't necessarily property values, which is something that I'm sure everybody's understanding. Property values are not the median price. The market shifts back and forth. You can have a time frame for whatever reason where more expensive communities are making up a larger percentage of that county's median price, which brings up the median and doesn't bring up property values. That's the whole concept behind my micro market areas that will be coming up later in the presentation, is I'm trying to group similar priced, similar geographical homes together to more accurately, without doing a CMA, determine what the market value is actually doing. Now we're looking at the 3 counties individually. We have Alameda County in the gray, back basically to its normal level of inventory. Santa Clara County in the blue, probably still a little bit short of its normal inventory. And San Mateo County in the orange, that actually had a record high level of inventory here, crossed over 600. You come back, you never had 600 listings at any given time. 550 was sort of the cap, and right now you're at about 520. So you're still very close to your previous cap, and you're higher. You're basically recovered. You're probably more recovered than Alameda County. So it was recovering the level of inventory. San Mateo County would be my number 1. Alameda County would be number 2, and Santa Clara County is still lacking of inventory. Here's offer accepted. So even though Santa Clara County had less inventory than Alameda, it's selling more. So it's going to have a faster turnover rate. Alameda County is second with the number of offers accepted, and San Mateo County is third because it's a smaller county. Remember, it only had 600 listings. There were times here where we had 600 offers with less than 600 listings, and now you have only 400 offers accepted with something like 550 listings. So you went from selling more than your inventory in a 5-week period of time to selling less in the inventory So San Mateo County has a slower marketplace than it typically does. And here is where we are on marketing time. So here is your marketing time. Orange again is San Mateo County. It would be normally down here somewhere around 30, 35 days. You're now at 45. So it's clearly got a longer marketing time than it typically does. Typically, when you come back here pre-pandemic, the orange was sort of on the bottom of this line. In fact, it was on the bottom of the line until the pandemic here in 2020. Since the 2020, it's sort of been on the top. What's that saying? It's saying that the consumer back here before the pandemic was paying a premium to live in San Mateo County. Now with more remote working, they're not willing to pay the premium, and so the market has slowed down. Santa Clara County has become the fastest pace because we have more outlying areas like Morgan Hill and Gilroy and Evergreen and Milpitas that have longer commutes that became more desirable, and so they are now having a quicker turnover rate. And Alameda County up here has the slowest turnover rate up here at something like 56 days to sell its inventory. Now, they're all reasonable. Santa Clara is about 39 days. San Mateo County is at about 45 days. And Alameda is probably closer to 55 days and reading it a little more accurately. Here's marketing time, very close together. You go from the fastest being Silicon Valley at probably about 31 days. And then you have San Mateo at 36 days and Alameda County at 37 days. Here's the magnitude of price reductions, very, very close together. It looks to me like Alameda County has the most price reductions at 1.650 price reduction. And then I can't tell, I would call San Mateo County and Santa Clara County at a tie at about 1.55% of price reductions, and that's average. Here's the frequency of the price reductions. Here, there's a little bit more separation. You can see Alameda County has the most price reductions with 23% of the sellers doing price reductions. Santa Clara next at 21%. And San Mateo County, the least amount of price reductions, 20%. They're all between 1 in 5 and 1 in 4 sellers are doing a price reduction. That means 4 out of 5 or 3 out of 4 sellers are not doing price reductions. Here's the overbid. So Alameda County, the slowest county, has the most overbidding at 4.5%. San Mateo County is next at about 3.25% overbidding. And Santa Clara County has the least amount of overbidding at about 2.25% overbidding. So overbidding is still occurring, but at lower levels than it typically is. You can see that back here, we actually went below at 2% off. So buyers were coming in below the seller's ask price. But that was a very short-lived period of time right here in 2023. You can see it's rare to even hit the 100% line right here. That would be the buyer offering the seller exactly what they're asking. The bulk of the time, we're above that line. Here's the frequency. Santa Clara County looks like it's right at 50%. Alameda County at 52%, and San Mateo County having the most at 56% of the sellers receiving more than their asking price. Here's the long-term appreciation. This is basically based on median pricing. So what you're saying is the median price in Santa Clara County raised the most and almost at 100%, which would be a doubling. It was more than 100% earlier. It's now at about 95%. Then you have Alameda County next at about 70% appreciation. And San Mateo County has the least appreciation at 65% appreciation. Here's the median sell price. You can see San Mateo County is slightly above Santa Clara County. And if I remember correctly, the number's 1880 for Santa Clara County and 1893 for San Mateo. So there was a $13,000 price difference. And the most affordable county is Alameda County down here at about $1,250. Here's on regular paper. The previous was on long, so you can see Alameda County, $1,250. So 1880 and 1893 for San Mateo County, just shy of 1.9 million. It's almost a tie. $13,000 separating them on a $1.9 million price. Here's the estimated payment. I use the national average for high balance conforming loan limits. So your payments, if you did a jumbo loan, would be lower here in Silicon Valley. And then if you're able to qualify for institutional relationship with Wells Fargo or Bank of America or pretty much any bank, Citibank, then you get even a lower interest rate. Here now, we're moving into micro market areas. Silicon Valley and the 3 counties are highlighted so they stand out a little bit more. You can see that the active inventory is 4% above where it typically is for the valley as a whole. You can see that San Mateo County has almost a 25% surplus, so 25% more listings than you'd expect. And Alameda County has a shortage of 2.3%. Santa Clara County and Alameda County are pretty much normal. San Mateo County has a surplus of inventory, and you can see that you got the blue here. But Los Altos now in Santa Clara County has a surplus too, as well as the affordable areas. I don't have micro markets data for the first several slides for Alameda County. Here's offers accepted. You can see that Silicon Valley is coming in at 82% of normal. San Mateo County is at 92%, so it's the healthiest. Santa Clara County is coming in right at the average, and Alameda County is lagging behind with only 80% of the offers that you'd expect. Here's the turnover rate. Santa Clara County is 16% slower than it typically is. San Mateo County is the slowest at 25%, but now really pay attention. The coast, it's taking twice as long to turn over the marketplace as it normally does. And then if you look at Santa Clara County, it's got a range as low as 85% in Cupertino and Sunnyvale. So it's taking less time than it normally does to turn over in Cupertino and Sunnyvale. Morgan Hill and Gilroy is 50% slower than it normally is. This is now raw numbers. Those first three slides we're comparing to the 10-year median. And so it's faster or slower than normal. Now it's the raw count. We were saying that East San Jose, the affordable areas, was much slower than normal, but they would turn over their entire inventory in a month and a half. Now jump down to something like Pleasanton. There it's taking almost 4 months to turn over their marketplace. In Castro Valley, it's taking 5.5 months to turn over their marketplace. The San Mateo County coast, it's taking, what is that, 4.5 months. So and look at the difference, 4.5 months on the coast to less than a month on the bay side. So the same county has a huge difference, and that's why you can't even look at countywide data. That's why I introduced micro market data. Well, I actually introduced micro market data back in '97 for my own benefit, and when I was buying and flipping properties on a daily basis. Here's your marketing time. Look at Cupertino, it's taking 60% of its normal time to sell. Los Altos is 70%, at the same time that Milpitas and Campbell and the associated areas are taking 30% longer. So overall, the county is 22% longer, but you have 3 areas that are less than 100%, and you have 4 areas that are greater than 100%. If you jump down to San Mateo County, it's going anywhere from 5% longer in the expensive areas to 63% longer in Pacifica and Daly City. And if you look at the San Mateo County coast, it's only 44%. So the days unsold inventory was the highest in San Mateo County, but the marketing time is actually more reasonable. What's that suggest to me? It suggests that there may be some sellers on the coast that are trying to sell that aren't, because sellers that try to sell that aren't successful does negatively impact or raise the DUI. It doesn't impact the days on market, because I'm not looking at days on market and what sells, because then it would weigh down by those that don't sell. I'm looking at the days on market of those sellers that are successful. So if you have a greater share of your marketplace that's not successful, that's how you can have DUI and days on market say 2 different things. Alameda County is at 50% overall, but look at this. Oakland at double the time it normally does, down to what's the fastest one? Berkeley and Alameda, 85%. And they're next to each other. Significantly different marketplaces, yes, but geographically close together. So one's taking twice as long and one's taking 15% less time than normal. Here's the actual time frame. Look at the same 48 days to sell in Oakland, drop down to Berkeley, and it's 18 days. You go up to the expensive areas in San Mateo County, 83 days. You look at the expensive areas in Santa Clara County, only 14 days. So you can have a huge, and you can really see in Santa Clara County, the market's red hot. You jump over to San Mateo County and it's cold. So overall, Silicon Valley is sitting at 34 days, 5 weeks. Santa Clara County is fastest, it's 31 days, followed by San Mateo at 36. And the slowest is Alameda County at 37. But again, look at the variations in each one of your micro market areas. 11 days in Cupertino and Sunnyvale to sell 3 out of 4 sellers, goes all the way up to 61 days in South County, Morgan Hill, Gilroy. Here's price reductions. How common are price reductions? 83%. That means that the sellers are taking a 1.7% price reduction. San Mateo County has the least price reductions at 1.8%. Santa Clara County next at 1.9%. And then you go all the way down to Alameda County at 3.1%. So Alameda County is taking fairly significant price reductions. In Berkeley and Alameda, they actually raised their price 0.5%. And that's ask price. So they're going on the marketplace. They're getting so inundated, they're raising the price. Now, it also could be people put the price in and made a typo and changed it, and I didn't catch it. I don't catch all of them, but I do try to catch most of them, trying to improve the accuracy of the data presented. Here's the actual number. So this is the average, 1.6% in all 3 counties. Each county has one hotspot. So Santa Clara's hotspot is Santa Clara, is Cupertino Sunnyvale, where they're getting a 4% price increase. San Mateo County hotspot, small geographical area at a 0.5% increase. And then Alameda's hotspot is Union City, Newark at 0.6% over. So you can see each county has one hotspot and the rest is pretty much blue. Here's the frequency of compared to normal. So it's only a third of what it typically is, but you go to Milpitas and it's 70% greater than it typically is. So that's quite a range in one county. You have basically the same range in San Mateo County. You go from 167% down to 79. So the 79 is higher than 34 actually. And then in Alameda County, they're much closer together, but it goes from 58%, that's approaching my 34, all the way up to 89% above. If this slide doesn't tell you anything else, it tells you that you can't look at the color for the county, which in all three cases is white, and see what's happening within the county, because you go from blue to red in all three counties. That's the concept between micro markets. The market in Cupertino Sunnyvale has nothing to do with the marketplace in Milpitas. Here's the frequency of those price reductions. You can see that roughly 25%, 20%, actually 20% of the sellers are doing price reduction, 21.6% for the Silicon Valley as a whole, 21.1%, 20% in San Mateo County, and Alameda County is doing the most price reductions at 22.8%. But look, again, you go from bright red to white to blue in one county, fairly close together, or you go from red, from pink to light blue to pink in a short distance along the peninsula. Now, granted, there are three different marketplaces, and that's the concept of showing you these maps, is how significantly different the market can be just a stone's throw away. Here's overbidding, and this is the average overbid compared to the 10-year median. So we have significantly less overbidding in almost all areas except in the northwest portion of Silicon Valley or Santa Clara County. That's about the only bright spot, except for, again, Berkeley and Alameda. They're a real holdout. They're at more overbidding than they typically do. They're 3% above their normal amount of overbidding. So one pink, one white area, and shades of blue almost everywhere else you go. This is the buyer overbidding compare on average. So you still have some significant overbidding going on here in Alameda, in Santa Clara County. What's significant? It's 5% overbidding. Cupertino Sunnyvale, 7% overbidding. But then you go down to Morgan Hill, and they're actually getting 1% less than their ask price with the offers coming in. San Mateo County, 2% less on the coast. So you go from 2.1% less to 4.7% above, depending on the geographical area within one county. Pleasanton, 2.7% below to 18.6% above. Alameda County's got the widest variation on this particular metric, which is the amount of overbidding and the amount of competition. Pleasanton has been fairly cool for a while now, but that doesn't mean any one property isn't going to bring in an overbid. Here's the frequency of overbidding compared to the 10-year median. Across the board, either blue or white, so clearly less overbidding than we typically get based on the previous 10 years. And keep in mind, the previous 10 years have been a pretty aggressive 10 years in Silicon Valley. Here's the frequency of overbidding. So even though it's cooler than normal, it's 52% overall, 50% in Santa Clara County, 56% in San Mateo County, and 52% in Alameda County. So Santa Clara County has the least amount of overbidding at 50% of the sellers getting more than their overbid. And again, that varies from a low of 29% in Morgan Hill to a high of 71%. San Mateo County, a little bit lower, 21%, but we only get up to 69% of the sellers getting more than their overbidding. In Alameda County, you go from a least of 26% up to a high of 73% of the sellers getting more than their overbidding. So I think Alameda County's got the broadest range from 26 to 73%. So that's fairly significant. 25% of the sellers are getting overbid in the slowest area to 75% of the sellers getting overbid in the most aggressive area in one county. Here's the long-term appreciation based on the last 9 months of 2015. Santa Clara County, the reasonably priced, reasonable commute distances are the areas that are having the most appreciation. Livermore was pretty good earlier. You can see it's calmed down. I think what happened was as companies put pressure on people to come back to work, Livermore is starting to be getting a little too far out for some of those people to commute in on a regular basis. Here's the pricing. So this is not market conditions, but simply where prices are the cheapest. And you can see the job force areas are still hotter, but Cupertino Sunnyvale area right in here is now redder than San Mateo County. And let's see if we can't pick that up. Cupertino is at $3 million, call it, for the median sold price. And you come down to San Carlos, 2.3%, 2.2 million even. So it's now more expensive to buy in Cupertino, Sunnyvale than it is in Redwood City, San Carlos, Belmont, San Mateo. Now you have to go in and look at the actual item that you're purchasing. You may get more house for your money in San Mateo County. You may get more house for your money in Santa Clara County. But historically, the prices were higher on the peninsula, and they currently are not. That's not the case. In addition to the median number in the middle, on the left-hand side is the cheapest 10%, and on the right-hand side is the most expensive 90%. So in Santa Clara County, a single-family home goes from about 1.1 million to 3.8 million. Now, that doesn't mean you can't come down to areas like East Central and South San Jose and get a house for 850,000. You might even get a house in a rough shape on a busy street for 800,000. But this gives you the range of where to expect homes. 80% of the homes are between the number on the left and the number on the right. 40% are between the number on the left and the middle number, and 40% are between the middle number and the number on the right. So using the affordable areas of Santa Clara County as an example, there's a $250,000 price range right here where 40% of the homes sell. And then there's basically a $500,000 range where the next 40% of the homes sell. So as you go up in price, you get quite a bit more money. Quite a bit more house for your money. And that's sort of going to be true in each of the micro market areas with slightly different magnitude numbers. Here's a summary chart. Here I put all the 10-year normals comparisons over on the left-hand side. So you can see in general, there are some exceptions like Cupertino coming across is red all the way across. And maybe even Los Altos, Palo Alto is red all the way across. But for the most part, there's a lot of blue. That's saying that the market conditions currently favor the buyer more than they typically do for the past 10 years. But then you come over into the yellow. These are the market indicators right now. So you still have a mixed market. You have some hot areas. You got some cool areas, hot areas. The red is hot, blue is cool. So you have to look at each one of the different micro market areas. And then the overbidding is lagging behind. So this would tend to suggest that these are pinker than over here, which would tend to suggest the market has been cooling off over the past 3 to 6 weeks. And then you have appreciation, and you really stand out here that San Mateo County has done less well than the other counties. Alameda County is sort of the most split county, with some areas having good appreciation and other areas having not so good appreciation. And then overall, the prices here. So your more affordable areas are still Alameda County, and then San Mateo County is sort of mixed, but sort of more moderate. Santa Clara County goes from bright red to bright blue, so a little bit more extreme on the price. Here's now the chapters you can jump to in the YouTube description below. You got your graphics and your chapter number and the timestamp, so you can keep track of which chapters you like the most. And we will be going into more Santa Clara County, Silicon Valley data coming up. This is Silicon Valley Real Estate Marketplace. We're not done. I'm doing a summary midway through, see how that works out for people. After the Silicon Valley, we'll get into the Greater Bay Area. The blue is the YouTube archive. The green is what I call my green root URL. That will take you to the YouTube channel with less typing. If you want to join the presentation Saturday morning live, you can type in the green root URL plus 2025. I am now putting up the direct meeting code up here if people want to use that and type in so they know they're actually going to Zoom. And the handout is up. I was a little bit later, and this is last week's long handout. I don't think I'm going to update that every week. If you type in the green root URL and the handout, you get there. If someone doesn't want to type in a secondary link and sends me an email, I'll send you the link. I just don't, I'm going to take the link out, and this is last week's link if you want to look at what's there instead of this week's link. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley. Appreciate likes and subscriptions. Anyway, now we go into the 3 distributions. We're looking at days on marketplace. This is a good example of why I don't like median days. There's basically no change over time down here. And you come up to the 75th percentile that I like using 3 out of 4 sellers. There's a lot bit more market condition changes. And you can also see what happens up here at the 90th percentile. What we're doing is you're starting off a year ago on the dotted line. The purple line is the current line. So you can see that across all days on marketplace, all market segments, it's taking longer to sell. So the high end is taking longer to sell. The median is taking longer to sell. Now the median is almost dead on, and the reason is what I alluded to earlier is half the sellers are selling in that first week, and that's why there's so little movement over here. Is if half your sellers are selling in the first week, you really can't move. You have to come up here to sort of the 75th percentile to have some movement. The concept here is week at a time. You can sort of see there's really no movement, so that would tend to indicate the purple line really shouldn't move very much. But now you're coming up into Halloween, November, and Thanksgiving, so you're really slowing down. That's sort of the peak at the end of the year. That right there is probably the slowest. It's already improving because it was flattening out on the right-hand side. Now you can see you gradually improve. From about there on, you're really not going to change very much. So you're sort of in the summer bouncing back and forth. So that's sort of where I'd expect the market to be. I really wouldn't expect much change going forward in time. Only time will tell where it ends up happening, but it's not until November that I'd expect this number to really climb. If this number continues to climb now in October, in September and October, that would really indicate that the market is slowing, because in a normal marketplace, you wouldn't expect any slowing. Now we're looking at the largest price reductions. You can see the seller that's taking the 2.5% sellers taking something like a 15, 16% price reduction over here. And the 17% seller is taking only a 3%. So there's only a 15% of the marketplaces where most of the price reductions occur. But again, you can see the purple line is significantly cooler than the dotted line of a year ago. And we start off 1 week at a time for several weeks. And you can see that, again, there's not really much movement. And now we're at October 11th. Now we're doing 2 weeks at a time, and you start seeing the movement. There it's getting really cool. It's already heating up. There's the peak of the marketplace on Valentine's Day, as well as March 1st. Now it's already cooling down fairly rapidly. And now you're at the beginning of June, and you're really already in the summer doldrums where there's really not that much movement one way or the other. In July, August, it's just bouncing around with no real trend. So you're taking larger price reductions this year. This is the largest price reductions we've ever had, the coolest marketplace. So you're closer to that blue line than you are to the red line. And, so across the board, every percentile seller is taking a larger price reduction. Here now is the buyer overbidding, same exact concept. A year ago, you were up on the dotted line. Across the board, hotter marketplace than the purple line. And we'll step through a week at a time. Now, remember that this is lagging. You need sale price. So even though we're now in the middle of October and doing 2 weeks at a time, it's going to go further into December before it really starts changing. Right now, January 3rd, January 31st. January 31st was the coolest. The hottest is March 15th, even March 29th. So everything's shifted later in the year. Here you can see you're cooling down. And right now, July 5th on, there's not going to be much movement. You're still stepping down a little bit. And again, you can see that the market is much cooler this year than it was just last year. Here's the number of offers. You can now see that we're the 8th slowest year out of the last 10, which isn't all that dramatic. We're also the 22nd slowest out of the last 25. 2007 is now slower. I don't know how many of you remember 2007. That's where we had the mortgage meltdown back in January, February, and the market slowed and slowed and slowed. And then the following August of 2008, we had the stock market corrections and then a further hit on the real estate industry. But in August and September of 2007 was the when we had the lowest number of transactions, and the number was only 1,700. So even in 2023, that had been historically low, we were selling 50 more units than we were in the record low year of 2027. So we're no longer in a record low year. It's not that the number of transactions have picked up very much. They've picked up a little. Back here, you were at 1,900. Now you're at 2,000. So you picked up 5% of the marketplace. But it's the 2007 was having fewer transactions. But by no stretch of the imagination is 2025 a great year at only 2,000. All you have to do is look back here and see 2,700, 2,800, 3,100 transactions, almost 3,200 transactions. So when you're at 2,000, you're clearly missing part of the marketplace, but you're not at the record low volumes. Here's the raw numbers for those that prefer Silicon Valley over on the left, Santa Clara next, San Mateo and Alameda County. You can see that the days of unsold inventory that improved dramatically going into the holidays have slowed down fairly significantly coming out of the holidays. And then I like pointing out, look at the variation in days on marketplace. Median is on here, average is on here, And my favorite, the 75th percentile is on here. So you can see they all are related to each other, but they're all different metrics of the same thing. You have appreciation since last 9 months of 2015, and also since the pandemic in 2020. We will be getting onto the Greater Bay Area next, the 5 regions, 13 counties. We have been talking about Silicon Valley in the previous slides. We will be talking about San Francisco, the Marin cities, North Bay, Sonoma, Napa, Solano, Contra Costa, Central Valley, San Joaquin, and Sacramento, and the Central Coast, Santa Cruz, and Monterey. Here's inventory. You can see inventory is going down. Overall, you can see the impact of Labor Day, most noticeably only noticeable basically in Silicon Valley and in the cities, the areas that are most impacted by high tech. Offers accepted down in Silicon Valley, basically up in all the other 4 regions. So Silicon Valley is bucking the trend and going down in the number of offers accepted, with the other 4 regions all going up slightly. Days unsold inventory or turnover, you can see the impact of the holidays most significantly and really only noticeable in Silicon Valley and the cities. You might be able to say you saw a little leveling off here in the North Bay and in the Central Valley. Central Coast goes, what holiday? Marketing time increasing in the North Bay, increasing in the Central Coast, flat in the Central Valley, flat in Silicon Valley, and a huge improvement in the cities. Ask price reductions, most price reductions on the coast, Central Coast, next North Bay, then the Central Valley. Huge reduction in price reductions in the cities, and Silicon Valley fairly flat with the least amount of price reductions at about 1.6%. Here's the frequency of seller price reductions. You can see that you have the North Bay and the Central Valley at 40% of the sellers are doing price reductions, Central Coast at about 37%, and then you drop down to the city and Silicon Valley at only 22% of the sellers are doing a price reduction. So fairly significant difference between 22% and 40%. The overbidding, where's the most overbidding? So the cities has the most overbidding going on right now at almost 8% overbidding. Silicon Valley is next at about 3.5% overbidding. And then the other 3 regions are all below the seller's ask price. North Bay is about 0.25% below. Central Valley is at a full percent below. And the Central Coast is about 2.25% below the seller's ask price. Frequency of overbidding, the most in cities at something like 57% of the sellers getting more than their ask price, followed by Silicon Valley 52%. And then you drop all the way down from 52% is more than 1 out of every other seller. Every other seller up here is getting more than their ask price. You drop down to North Bay, it's 1 out of 3 sellers. Drop down to Central Coast, and it's 28%. And you drop down to Central Coast, and it's 22%. Almost 1 out of 5 sellers are getting overbid. So from 1 out of 5 to more than 1 out of 2. So that's quite a range. And again, you can see where the hot spots are, being Silicon Valley and the cities. Here now is a completely different picture. The cities is doing the least well. It's only got 30% appreciation since 2015. Where the Central Coast has 100% appreciation. Now, and the Central Coast, it very well could be they're selling more coastal properties, pulling up the price, which pulls up appreciation. Central Valley is right now has a better appreciation rate than the Silicon Valley in the purple, and the North Bay has 70% appreciation, and that's since 2015. Here's the median sold price. You can see the prices are somewhat stable. You can come back, and the reason for the horizontal lines is you can see that Silicon Valley is basically just below their peak of 2022. Cities is significantly below its 2022 peak. And if you come back to the cities, they first hit their current price level in 2018. The Silicon Valley didn't hit that price until 2022. The coast is at a record high number, the Central Coast. There's no time frame, and that's why I think it might be market mix. The North Bay is basically right at its previous peak, and then the Central Valley is previous peak. Now, if you look at it closely, both of those, North Bay and Central Valley, are slightly below their 2022 peaks. So only the Central Coast isn't below the 2022 peak. Here's the fixed pricing on interest rates. I go through I'm using national average, high balance, conforming loan limits, which is artificially high. I'm putting an estimate in for property tax, and the current order is going to be the same as the pricing. But here you can see your payments are higher now than they were in the 2022 peak across all regions. And that's the purpose of this. So even though pricing is lower than the 2020 peak, their payments are significantly higher because of the interest rates. And here are the numbers. little slightly different way I'm presenting it. The now column is the raw count for each one of the 13 counties in the 5 regions. I also put in the Bay. It's a garbage number, but I put it in here because the media's here reports it. I then also do the percent change from 1 week ago and the percent change from 5 weeks ago in all the key metrics. As I said earlier in the presentation, these are the chapters you can jump to in the YouTube description below. We've been talking about the Silicon Valley real estate marketplace. We finished up with the Greater Bay Area and not seeing any of you, Mike. So I'll see you all next week. Take care. Bye for now.